accounting start. Let's say you decide to go for hedge accounting. What are the steps, right? First is that you have to, of course, change your accounting policy saying that I want to go for hedge accounting. Now, again, there is no restriction on you to go for hedge accounting, or once you decide to go for hedge accounting, every hedge has to be accounted for in the same fashion. It's not restrictive. It is basically, what you mean is, once you decide hedge accounting, you can say, you have a choice of saying, I will do hedge accounting only for my loan hedges. I will not do hedge accounting for my import hedges or export hedges. You can say that, right? There's no restriction there. Similarly, even if assuming that I'm going for a hedge accounting of all my loan hedges, but if you miss certain steps in the hedge accounting for one given transaction, that still might continue to be out of hedge accounting. Every other transaction will continue to be in hedge accounting framework. So it is not that you have to do for every trade. Again, each trade you have a choice to go for or not to go for. So let's assume you won't want to do hedge accounting. What are the steps? The first step is you have to first define the hedge relationship very clearly. There is a clear documentation that you have to do saying what is my hedge relationship between the hedged item, which is the risk that I'm hedging, and the hedged instrument, which is my derivative hedge. So the documentation has to be very clear, meaning if I'm doing a forward hedge, the documentation should say my hedging risk is the spot risk, not the forward risk, right? Because you are hedging an export using a forward, the export revaluation is your risk. Therefore, spot risk is what it is, not the overall forward. So if you define it clearly like that, in a forward contract, the spot risk is what you will look at for effectiveness, and the forward premium risk will be kept aside separately. So there are some nuances here. Documentation has to be very specific. Similarly, currency swaps, you have to be very clear. What is it, principal part that I'm doing, or is it the interest part, or is it the LIBOR risk, or is the overall all the risk into one deal, and so on. Similarly, in options, again, this is a tricky part. So in a forward, it's still understandable, right? Forward is a linear instrument. 1 rupee change in spot means 1 rupee change in the mark to market of the forward is linear. Options are not like that. Options are not linear. They're non-linear instruments, meaning if there is this underlying spot risk which you are trying to hedge and it changes by 1 rupee, the spot rate, option MTM doesn't change by 1 rupee, and so on. So you have to be very clear as to when you're using an option, the option per se is not the hedge. The intrinsic value of the option, the option MTM has to be broken down, intrinsic and time value. Then intrinsic value is what you're hedging. The time value are the other aspects of option value.